Hello viewers, so welcome to my channel. I'm Hasham Ali Khan. So this is the last and final video on CVP analysis. In this video, last four problems I'm going to explain you. So already we have completed 36 problems. Now if you are regularly watching all the videos, definitely you got a good command on this topic of decision analysis, CVP analysis. Now, before starting the 37th problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. Take the screenshot of the points, then I'll explain. Now, see the 37th problem. Mamta Limited manufactures three products, namely heavy, medium and light. The details of which are given below. Heavy, medium, light. Three products are there. Selling price per unit 80, 50, 40. Direct material per unit 30, 25, 20. Other variable cost per unit 14, 11, 8. Fixed overheads per unit 10, 8, 6. Total 54, 44, 35. Material consumed per unit 10 kilogram for heavy, 6 kilogram for medium and 4 kilogram for light. The company is thinking of discontinuing one product and focus on the other two products. If there are no limitations on either material, labor or sales, which product should be discontinued? First question. Second question, assuming that material is in short supply, which product should be discontinued? Fixed overhead will remain constant irrespective of the product mix. So here the company wants to drop one product. If there are no limitations, no key factor, no limiting factor, then which product should be dropped? Second question, if material is in short supply, that means there is a limiting factor. Material is the limiting factor. In that case, which product should be dropped? Now, first of all, if there are no limitations at all, then every product which gives a good contribution, that will be kept. And the product which gives the lowest contribution, that can be dropped if there are no limitations. If there are limitations, then we have to find out contribution per unit of that limiting factor. So whichever product has less contribution, that should be dropped. So first of all, we need the contribution, means sales minus variable cost. So very easy problem comparatively. Statement of contribution, heavy, medium, light. Selling price per unit 80, 50, 40 given in the problem. Variable cost per unit, direct material and other variable cost. Fixed cost should not be taken, because fixed cost will be incurred whatever be the sales mix that is given in the problem. Now, only direct material 30, 25, 20, other variable cost 14, 11, 8. The total variable cost 44, 36, 28. Contribution, selling price minus variable cost, you will get the contribution. 80 minus 44, 36. Then 50 minus 36, 14. 40 minus 28, 12. We got the contribution. First answer is completed. If there are no limiting factor, if we have plenty of material, plenty of labor, plenty of sales, no restrictions, then in that case, whichever product has lower contribution, that can be dropped. Here contribution 36, 14, 12. 12 is the lowest contribution. So we suggest if there are no limiting factors, then product light should be dropped because it is having lowest contribution per unit. First question completed. Second question, if material is in shortage, so it is given in the problem how much material is required per unit. For making 1 unit of heavy, 10 kilogram of material. For making 1 unit of medium, 6 kilogram material. For making light, 4 kilogram material. This is the material required per unit. Now what is the contribution per kilogram of material? Contribution per kilogram of material means contribution per unit divided by material required per unit. So contribution per unit is 36. Material required is 10 kilogram. So 36 divided by 10, 3.60. 3 rupees 60 paisa is the contribution per kilogram of material in case of heavy. In case of medium, contribution 14 divided by 6, 2.33 is the contribution per kilogram of material. Light, 12 divided by 4, 3. So we got the contribution per kilogram of material. So if material is the key factor, if material is in short supply, that product can be discontinued, which gives lowest contribution per kilogram of the material. Here 3.6, 2.33, 3. The lowest is 2.33. That means if material is in short supply, the company is advised to drop medium. That's all. So here, if there are no limiting factors, product light should be discontinued. This one. Light should be discontinued as it gives lowest contribution. If material is in short supply, then product medium should be discontinued. Here, medium. As the contribution per kilogram of material is lowest in case of medium. That's it. This is the end of problem number 37. Now, problem number 38. Sanjay Limited manufactures a product whose cost details are given below. Material 35 rupees, labor 12.5, factory overhead 62.5, 50% fixed. So we classify 50% fixed and 50% variable. And sales overhead 25% variable, the remaining 75% fixed. Total cost of 60,000 units is 118. The company sells 60,000 units of the product at rupees 143 per unit in the domestic market. Home market. The company has sold 60,000 units at a selling price of 143. It receives an order to supply 20,000 units of the product at rupees 98 per unit, which will be sold in the foreign market. That means special order. A special order from foreign country has been received for 20,000 units and they want to purchase at a price of 98 rupees. We are selling in the home market at 143, but the foreign customer wants to purchase it at rupees 98. Now we have to analyze and decide whether the foreign offer, special order, can be accepted at 98 or should we reject it. There is sufficient spare capacity available with the company. Should the company accept or reject the offer? Now the company is having a spare capacity. That means no further fixed cost is required, because within the 100% capacity itself we can make that extra 20,000 units. So extra 20,000 units does not require additional fixed cost. Whatever fixed cost right now we are paying, the same fixed cost will be continued whether we accept the order or not. So fixed cost ignore. So we calculate the variable cost per unit and compare it with the offer price. The offer price is 98 rupees. If the variable cost is less than 98, we accept the offer. If the variable cost is more than 98, we reject the offer. So we need variable cost. See here, Sanjay Limited variable cost per unit, material 35 rupees, labor 12.5. Factory overhead 50% is fixed given in the problem. So 62.5 into 50%, 31.25. Sales overhead is 25% variable. So 25% of 8 rupees, 2 rupees. The variable cost comes to 80.75. To make 1 unit 80 rupees 75 paisa, whereas the foreign customer has offered the price of 98. Foreign market offer price is 98. So profit per unit are from accepting the foreign offer. If we accept the foreign offer, how much profit we are getting? 98 minus 80.75, 17 rupees 25 paisa profit per unit we are going to get. And how many units we have to sell it to the foreign customer? 20,000. So 20,000 into 17.25, 3,45,000. So if we accept the foreign offer at 98 rupees, then we get an additional profit of 3,45,000. So we suggest the company to go ahead to accept the foreign offer at 98 rupees. We are getting a profit of 3,45,000. The fixed cost is ignored as it is irrelevant. It has to be incurred whether we accept the foreign offer or not. because there is a spare capacity available to make that extra 20,000 units. Next, 39th problem. Deepak Limited makes an average profit of 30 rupees per unit by selling at rupees 450 per unit, whose cost breakup is as under. So the company makes a profit 30 rupees and selling price 450 rupees. How we got 450 rupees? The breakup: material 105, wages 40, factory overhead 180 rupees at 60% capacity, 50% fixed. So of 180 rupees, 50%, 90 rupees fixed and 90 rupees variable. And sales overhead 40 rupees, 25% variable, 75% fixed. So we bifurcate, divide. 25% of 40 rupees is 10 rupees. So 10 rupees variable, 30 rupees fixed. The company currently produces 6,000 units. For the coming year, it receives an order from a large retail chain of supply of 2,000 units. Again, a special order. Presently, the company makes 6,000 units. Now the company receives a special order for 2,000 units. It anticipates that material and wages will increase by 6% and 8% respectively, while fixed overhead will go up by 10%. The company wants to earn a profit of 6 lakh rupees in the coming year, but it cannot increase its selling price in the normal market. In the home market, we cannot increase the selling price. The present selling price is 450 rupees. We can sell at 450 only. What price can it accept the order for 2,000 units? What is the selling price to be fixed for 2,000 units? That's what we have to find out. We want a target profit of 6 lakh rupees in the next year, coming year. First of all, we calculate what is the profit in the current year when we sell 6,000 units in the home market at rupees 450 each. See here, statement of contribution and profit, total per unit. Sales, per unit we are selling at 450 rupees and presently in home market 6,000. So 6,000 into 450, 27 lakh. Similarly, variable cost, material 105 into 6,000, 6 lakh 30,000. Wages 40 rupees per unit given in the problem, 40 into 6,000, 2 lakh 40,000. Then variable overhead 90 rupees. Actually 180 is given, 50% we have taken 90. 90 into 6,000, 5 lakh 40,000. Similarly, variable sales overhead 40 rupees is given, 25% variable. So 10 rupees into 6,000, 60,000. Total variable cost 14 lakh 70,000, 245 per unit. Contribution, sales minus variable cost, 27 lakh minus 14 lakh 70,000, 12 lakh 30,000 is the total contribution. And per unit 450 minus 245, 205. Right? From contribution, we deduct the fixed cost. Now the fixed cost are factory overhead. 180 rupees are given, 50% variable, 50% fixed. So 90 into 6,000, 5 lakh 40,000 is the total fixed factory overhead. Similarly, sales overhead. Sales overhead 25% variable, 75% fixed. So 75% of 40 rupees is 30 rupees. So 30 into 6,000, 1 lakh 80,000. Bracket denotes minus, subtraction. So 12 lakh 30,000 minus 5 lakh 40,000 minus 1 lakh 80,000, 5 lakh 10,000 is the profit which is earned during the current year. Now we have to go for the next year. Next year, material charges, labor charges are increasing. Even fixed overheads are also increasing. So first we calculate the increase. For the coming year, material per unit is increased by 6% given in the problem. So last year, how much is the material? 105. So 105 is 6%, you add up. So it will become 6.3, 111.3. 111.3 is the material per unit in the next year after increase of 6%. Labor charges are 40 rupees at present and next year it is going to increase by 8%. So 8% of 40 rupees, 3.2. So 43.2 is the labor cost per unit in the next year. Similarly, variable factory overhead per unit, there is no change. Last year, variable factory overhead 90 rupees and variable selling overhead 10 rupees. There is no change at all. That variable factory overhead per unit and selling overhead per unit 10, same, right? Now variable cost per unit. Finally, we calculate the total variable cost. That means 111.3 plus 43.2 plus 90 plus 10. You will get 254.5. To make 1 unit, the variable cost is 254.5 in the next year. How many units we are going to make? 8,000. Because 6,000 in the normal market and 2,000 we are going to make for special order, foreign market, let it be. So totally 8,000 units we are going to make in the coming year. So 8,000 into 254.5, 20,36,000 total variable cost. To total variable cost, we add the fixed cost. Last year fixed cost was 5,40,000 and 1,80,000. If you add up 5,40,000 plus 180, 720. Now it is given in the problem that fixed cost will increase by 10%. So 10% you increase, 72,000 you increase, 7,92,000 is the total fixed cost to be incurred in the next year. Now variable cost plus fixed cost will get the total cost 28,28,000. Total cost next year. Total cost, we add the profit. There is a desired profit. We want to earn a desired profit of 6 lakh rupees next year. That is given in the problem. So add up this revised profit 6 lakh. So total sales will be 34,28,000. Total sale proceeds we need is 34,28,000. Out of which in the domestic market where we sell 6,000 units, the price is not going to change. We are keeping the same selling price what we have earned current year 450 rupees. Next year also 450 rupees. So 6,000 into 450, 27 lakh rupees sale proceed we are recovering from the normal market, domestic market. So deduct 27 lakh. 7,28,000 we have to recover the sale proceeds from the foreign special order of how many units? 2,000 units. So sales required from additional 2,000 units is 7,28,000. So we need the sale proceed of 7,28,000 by selling 2,000 units. So what is the price per unit? So selling price per unit 7,28,000 by 2,000, 364. Finally, the company should accept the offer of 2,000 units at a price, minimum price of 364. If the price is less than 364, we cannot be able to get the target profit of 6 lakh rupees. We cannot get. If the price is more than 364 charged for 2,000 units, our profit will be more than 6 lakh. If you want exactly 6 lakh rupees profit, you have to accept the offer at 364 rupees per unit. That's all. This is the end of problem number 39. So 39 problems we have completed. Now last and final problem 40th. See the 40, problem number 40. Pankaj Industries produces 3 types of detergents: light, strong and white. The details of which are as under. Light, strong, white. Materials are given, labor is given, variable overhead. Fixed overhead, selling price, number of units. The management wishes to focus only on 2 products. The sales manager states that if a product is discontinued, the other 2 products can be increased by 50%. What is your advice to the management? So management wants to drop 1 product, any one of the product, and the other products, remaining products will increase by 50%. That is the contention of the management. Now we have to decide which product should be dropped, which product should be discontinued, light, strong or white. So first of all, we need to calculate the contribution per unit and the total contribution. So here you can see statement of contribution, particulars, light, strong, white. First of all, selling price is given 1,360, 1,800, 760. Selling price given. Variable cost, material, labor, variable overhead. Fixed overhead we have not taken, only variable cost we require. So material for all the 3 products, labor for all the 3 products and variable overhead given. Take the total. The variable cost is 760, 1140 and 420. And we know the contribution is the difference between sales and variable cost. Sales minus variable cost is the contribution. So 1360 minus 760, 600 is the contribution per unit of the first product, light. Then strong, 1800 minus 1140, 660 is the contribution per unit of second product, strong. Last, white, 760 minus 420, 340 is the contribution per unit of white. Now after calculating contribution, number of units are also given in the problem. The number of units are 1000, 1500, 2000. Now if you want the total contribution, multiply contribution per unit with the number of units. So here 600 into 1000, 6 lakh is the total contribution for first product light. Second product strong, 1500 into 660, you will get 9,90,000. 2000 into 340, you will get 6,80,000. So what we have calculated here, contribution per unit and the total contribution, right? Now we have to give the decision which product should be dropped. So if the other products cannot be increased, then that product will be dropped whose contribution per unit is less. Here contribution per unit 600, 660, 340. So 340 is the lowest contribution, that product can be dropped. If there is no increase in other products, we can drop the white product. But in the problem it is given that the management thinks that if any one of the product is dropped, the remaining product will increase by 50%. In that case, we see the total contribution, not the contribution per unit. Total contribution. Whichever product has a lowest total contribution, that product can be dropped. So here 6 lakh, 9,90,000, 6,80,000. So which product has the lowest total contribution? First one, light. So light product can be dropped if the other products sales will increase by 50%. That's all. So here based on contribution per unit, the management should drop the product white. White should be dropped because contribution per unit is less. However, it is also noted that number of units sold will increase by 50% if one product is discontinued. If one product is dropped, the other product sales will increase by 50%. In such a case, the decision should be based on total contribution and not on contribution per unit. Now our decision will be on the total contribution if the other products sales will increase. Now the product light is earning total contribution of 6 lakh, so only it should be discontinued. So 6 lakh rupees the total contribution received from light, lowest total contribution, that can be dropped, right? And note, fixed costs are not considered for decision making as they will remain the same irrespective of the product mix. Whatever change in the product mix, the total fixed cost will remain same. That is our assumption in decision making problems. So totally I have completed 40 problems on CVP analysis. So if you want the perfect knowledge, watch all the videos from beginning till end. And always copy down the notes, the problem solutions, everything. Then only you can be able to remember. Inshallah, we will take up the next topic, next unit in the next video. So if you are satisfied, give a like to the video, share my channel, subscribe if you have not yet subscribed, and buy the super thanks which is given below my video. Inshallah, we will continue in the next video.